Okay, folks, now for part 2 of the video, let's have a look at what the financial statements would look like. So, if you check the question, it wants you to prepare parts of the 2017 and 18 comparative statements, the statement of financial position, statement of comprehensive income, and statement of changes in shareholders' equity, only the FV-OCI part, and they want you to show how the investments and related accounts are reported. So, let's first of all take a look at the statement of earnings, which is your income statement. The reason why we have dividend revenue in here is because, as you know, we had dividend revenue because the Josie shares were paying a dividend. And I believe the Earl shares at one point in time paid a dividend as well. So if you go back to the year 2017 and you go back to your entries, you can take a look here and you can see that we had $1,800 in dividend revenue. Those were on the Josie shares. Then in 2018, if we go here, we can see that the Earl shares also had a dividend in there, right? Dividend revenue of $1,800. Or I should say the Earl shares had dividend revenue of $3,600, and the Josie shares also paid another dividend. So in 2018, we had $1,800 and $3,600, which is $5,400 in dividend revenue, and that goes into your income statement or statement of earnings. And we had $1,800 from the Josie shares in 2017. So these are the numbers that we have down here on your income statement or statement of earnings. Now, if we go down to the statement of comprehensive income, this gets a little more involved. Remember from class, the statement of comprehensive income is in two pieces. It starts with net income that we have from the statement of earnings, and we add in there any OCI that we booked during the year. Don't forget the OCI that we booked during the year is going to look at any unrealized gains or losses on fair value through OCI investments that were booked during the year, including your year-end adjustments for that year, as well as what you did in your step 1 if you sold any investments, right? So in our case, we had some investments that we sold during the year, so we needed to make a step 1 adjustment. From that OCI amount, we're going to deduct anything that we reclassified in step 3 to retained earnings. And we had some stuff. That's going to give us an OCI amount for your current year's statement of comprehensive income. So with that in mind, let's have a look at the statement of comprehensive income. First of all, I'm assuming, I'm making it up, I'm just saying, let's say we had $100,000 in income in 2017 and $100,000 in income in 2018. You'll remember those are our columns up here. Now, I'm including in there any dividend revenue, so you can assume your $1,800 is in here and your $5,400 is in here. All right? What was our OCI in 2017? Well, we want to go look at any year-end adjustments we made at December 31st, 2017. Plus, we also want to look at any fair value through OCI investments that we sold during the year for which we made a step 1 adjustment. So let's go have a look in 2017. What did we book into OCI that year? Well, if we go back here, we know that we had an unrealized gain or loss credit of $840 that we booked during the year. That was our step 1 adjustment. Don't worry about that. That's what gets reclassified. We'll get back to that in a moment. What else did we put in OCI that year? Our December 31st, 2017 adjustment, which was $81.10. So if we take that $81.10 plus the $840 here, that's going to give us $89.50. Is that not so? Correctamundo. That's what you will get. So we're going to go down here. I know we're scrolling a lot, but we have to do it to make sure you're clear where things are coming from. That's your $89.50 in 2017. But don't forget, in step 3, we reclassified, because we had a sale during the year, we reclassified any of the cumulative unrealized gains and losses on those 300 Asher shares that we sold during the year. We reclassified that to retained earnings. So what did we have? we had $300 gain that we reclassified. Let's go back and make sure when we go check our step 3 in 2017, let's make sure we know where this 300 is coming from. So go back to your 2017 entries, right, where we sold some of the Asher shares. Here's where we are. We sold the 300 Asher shares. Remember that we took an unrealized gain because don't forget we paid $9 a share originally and we dumped them for 10. So we had a cumulative unrealized gain of $1 a share. That was a $300 unrealized gain. We're going to debit that gain to reclassify it to retained earnings. So we're going to deduct the cumulative unrealized gain. In this case, it's a gain, right? We're going to close it off and reclassify it to retained earnings. So that gain comes out of your OCI this year. So we got to minus that 300, and that's exactly what we're doing here. And that's going to give us $8,650. Remember, any OCI that you have in the Statement of Comprehensive Income, your final number, your OCI that you booked during the year, less what you reclassified, that's going to update your AOCI. All right, and we'll get to that AOCI amount in a minute. Let's just finish the Statement of Comprehensive Income. So this OCI gets added to my net income to give me comprehensive income of $108,650. What do I do in 2018? Well, I'm going to assume again that I have $100,000 in net income, which includes my dividend revenue. Again, I'm just assuming it. It's assumed just to give you a number so you can calculate a final. Now, what did I book in OCI during the year? Two things you did for sure in this question. You made a year-end adjustment at the end of 2018, and you also had a sale. Don't forget, you sold the rest of the 200 Asher shares during the year. So I have to look for any step 1 and year-end adjustments to find out what went into OCI, and then I can deduct anything that I reclassified. All right? So now, let's have a look. So I'm going to go back and see what my year-end adjustment was in 2018 and any step 1 adjustments I made. So let's go on back. 2018, I made an adjustment of $4,200, right? I booked $4,200 unrealized gain. And if I go back to step 1, because this was the year that I sold the other 200 of 500 Asher shares, I booked an unrealized gain or loss debit, which is a loss, of $200. So if I net out that loss from that gain, I'm going to have a net gain that went into my OCI this year of $4,000. But I also deducted, which is what this minus sign is for, anything I reclassified to retained earnings. And notice I'm saying I'm lessing or minusing a loss of $400. So negative with the bracket means I'm reclassifying a loss. So I'm deducting a loss, so it's minus a minus, which is plus a plus. But let's make sure we know where this is coming from. This should be a step 3 item, right? So of all the OCI I booked, how much of that cumulative unrealized gain or loss that I am now got reclassified to retained earnings once I sold the rest of the Asher shares? Let's go step 3, transaction 2018. Well, here it is. There's my step 3. And don't forget, I know I had a loss. Why? Because don't forget, I bought those 200 of 500 Asher shares when they were trading at $9 original cost, but I sold them for $7 a share. I lost $200 a share from the date that I bought them to the date that I sold them. That's a loss of $200. 200 shares times $2 a share. It's a loss. That loss has to be closed out. A loss is a debit balance. It has to be closed out and reclassified to retained earnings. So for me to close out the loss, I need to credit it and debit retained earnings, right? So there's my loss, my cumulative loss on these shares that I'm now going to have to reclassify to retained earnings. So it's less a loss. So there's my less, that's my less, a loss. A loss is in brackets. So minus a minus is a plus. So I've got 4,400 added to the 100,000 gives me comprehensive income of 104,400. All right. Now, what would be happening in my statement on my statement of changes in shareholders' equity, but I only want the AOCI piece? Well, I got to look at where I started and where I ended. Now, let's think about this. How did I get from the beginning to the end? Remember at the beginning of the question, this is the balance at January 1, 2017. You should recognize this. This is the balance we calculated at the end of 2016. And I mentioned to you at the time we were doing the first video with the entries that we were going to go back and do or calculate the AOCI balance at the end of 2016 because we might need it when we did the statements. And here we are. So how did we get that? Don't forget, whenever you're looking at calculating an AOCI balance, AOCI only holds all of the cumulative unrealized gains and losses in any investment that you still have on your books that's fair value through OCI in shares. It's the difference between the original cost that you paid for all the fair value through OCI equity investments you still have in your portfolio in comparison to their fair value at the date for which you're calculating AOCI. So let's go back to January 1st, 2017, which is the end of 2016. If we go back to the very top, we did this. We said our original cost was $37,500 at the end of 2016, and our fair value was $29,950. That means our AOCI balance at January 1, 2017, i.e. the end of 2016, is a debit of $75.50. So to do our statement of changes in equity, but just the AOCI piece, we start with that debit balance. And I said to you, we can use that balance, find it using our 2016 information. What did we put into it this year? In OCI for the year was $86.50. So that gives us a balance of credit netted out against debit, gives us a net credit balance of $1,100. It's a shareholders' equity account. Just like any other shareholders' equity account, whether it's retained earnings or any share capital, its balance becomes the opening balance for the next year. And we know that in the next year, 2018, we booked $4,400 in other comprehensive income. That gets added in. $5,500 is your ending balance of AOCI. So what would I have in my shareholders' equity section? Or what would I have in my statement of financial position? Well, I would have my long-term investments, okay, my fair value through OCI investments at $39,100 in 2017 and $41,700 in 2018. If you go back to the charts that we prepared where we calculated these amounts, you'd see $41,700 at the end of 2018. That's your fair value from when you did your fair value adjustment, and $39,100 from when you did your fair value adjustment at the end of 2017. That's going in there. We already did our statement of changes in AOCI to show you where the $1,100 and $5,500 came from, so we can use those here. All right? Now, the other way you can calculate these two little fellas, if you didn't want to wait till you got down here in the statement of changes in AOCI, your shareholders' equity piece to figure it out, is go back to compare the original cost of all the investments you still have at the end of 2017 to their fair value at the end of 2017. Do the same for 2018. And you can come up with these numbers directly without having to do a statement of comprehensive income to show it. How do we do it? Well, again, you'll notice I got a little number 1 here, and that's showing you that AOCI is equal to the cumulative unrealized gains or losses on all the investments still sitting in the portfolio, all the shares that are still held. And that's equal to the difference between the original cost of those investments and their fair value. So let's go have a look at the original cost and the fair value of all the investments that we had at the end of December 2017. That's why here, you'll notice I included the cost column. Remember I said to you earlier in the entries, I said we don't need this column now, but we'll use it later. If we compare the cost to the fair value, you can see that's an $1,100 increase. So your AOCI is sitting at the difference between fair value and cost. Because fair value is higher, cumulative unrealized gains in this case are $1,100. So that's your AOCI balance, credit $1,100. And what do we got at the end of 2018? Well, if we go here, we see our cost was $36,200, our fair value was $41,700, and what's the difference? Well, that difference is significantly higher. It's a difference of $5,500, and that's a credit balance. So that's how we get here $1,100 at the end of 2017 and $5,500 at the end of 2018. So that's another way you can get it if you didn't want to wait to do a statement of comprehensive income to find out how much your AOCI was being adjusted by, so you could come up with this. But they did ask you to do a statement of changes in shareholders' equity, just the AOCI piece, and that's a good thing to do because now you have another way to check to make sure that your AOCI is the right balance, which should be the difference between the original cost and the fair value of your investment at the date for which you're calculating your AOCI in those share investments. So I hope this helps you to understand the preparation of the financial statements when we have fair value through OCI investments.